You're staring at your screen, and without warning, the floor falls out. The S&P 500 dives 2% in an hour. You scramble to check the financial news, but the headlines are silent. There's no earnings miss, no policy shift, and no obvious reason for the crash. So how do institutional traders consistently navigate these sudden drops? How do they position themselves ahead of the curve when they don't have tomorrow's newspaper? They don't guess. They rely on a disciplined methodology called technical analysis. And while it might look like a chaotic wall of lines, it is a strict study of market action, meticulously codified by pioneers like John J. Murphy. Traders can memorize every moving average, Bollinger Band, and candlestick pattern ever invented, but these tools remain incoherent until the trader understands the three bedrock assumptions they are built upon. Murphy's framework begins with 3 rules. Internalizing them allows a trader to stop chasing headlines and start observing the actual mechanics of the marketplace. The first assumption is that market action discounts everything. This means that every known piece of fundamental data, every economic forecast, political election, and shift in mass psychology is already reflected in the current price of an asset. This explains why a company can report record-breaking profits only to see its stock drop the very next morning. The market anticipated that growth weeks ago, and buyers already drove the price up to match. There is one notable caveat. Sudden, unpredictable black swan events, like a natural disaster, cannot be priced in until the moment they occur. But outside of those rarities, price is the only complete dataset. Therefore, the technician focuses on the effect, the price action itself, rather than guessing the fundamental cause. That leads to the second pillar. Prices move in trends. Think of market momentum like physical inertia. An object in motion tends to stay in motion. Markets move in 3 directions: an uptrend, a downtrend, or a sideways trading range. Looking right, it climbs in a series of ascending waves. This zigzag pattern of higher highs and higher lows is the anatomy of an uptrend. This is why technical analysis is centered on trend following. It is far safer to align your positions with the dominant market forces than to fight against them. Identifying a trend early in its development is the trader's primary task. It ensures they are swimming with the current rather than being pulled under by it. The final rule is that history repeats itself. Price charts provide visual maps of mass human psychology. Every data point represents the shifting balance between fear and greed across the global marketplace. Because human nature remains static, the way crowds react to panic or euphoria repeats consistently across different decades and different asset classes. This chart shows a specific zigzag pattern. When this shape forms and breaks its trend line, it signals a reversal, showing that the crowd is reacting exactly as it has in previous cycles. By looking backward at historical human behavior, the technical analyst finds the only empirical way to forecast future moves. It's important to be clear. Technical analysis is not a crystal ball. It deals strictly in probabilities. Because there are no certainties, strict risk management is the only way a trader survives a wrong prediction. To see how these rules work together, we can look at this price channel. The trend is clearly upward, giving us our first direction. When the price dips and bounces off a historical support level, we're seeing history repeat. Traders remember where the price turned before, and they act on that memory again. When the price suddenly breaks upward with massive volume, the charts show us that new information is instantly being discounted into the price. We don't need to know the news event. The price action tells the story. These 3 pillars are the prerequisites for everything that follows in market education. Mastering them is the first step in a larger journey. To see where this logic began, we have to go back to the origins of the discipline, Dow theory.